This may come as a surprise to many of you. The Federal Reserve doesn't know what it's doing. This is one of the most powerful entities on earth, and sound management of monetary policy, which is what the Fed does, is the most important thing that stands between us and the Great Depression. And I'm going to show you right now that they don't know what they're doing. There was a story in the Wall Street Journal last week reporting on comments made by the Fed. Here's the story. Page 1. This is big news. Just consider the first sentence of this one-page story. The Federal Reserve is preparing effectively to abandon its strategy of preemptively lifting interest rates to head off higher inflation, a practice it has followed for more than 3 decades. The first sentence tells us everything. First, that Fed policy has been a failure. Otherwise, why are they abandoning their approach to targeting inflation, which, by the way, is one of the central reasons the Fed even exists? So this is not a tangential issue. The second is that it tells you that you really need to think for yourself when you consume any media, because I don't know how anyone could say the Fed has been preemptive for more than 3 decades. Here's the Fed's preferred inflation measure. Let's look at the more than 3 decades part first. I've added a horizontal line to indicate 2% inflation, which is the Fed target that became explicit during Yellen's tenure. Do you see any evidence of preemptive measures to keep inflation low and stable? No, because inflation was way above target the whole period. Next is the 90s. Now we're in the Greenspan era, the maestro. And what we see here is that inflation was well above target for most of the 90s, and I can tell you because I was listening to every word Greenspan said at the time, and he was most definitely not an inflation hawk. The dollar was rising, money was pouring in from all around the world to invest in the US stock market, and inflation was subdued. I don't think anyone would describe Greenspan's tenure as one marked by preemptive lifting of rates to head off higher inflation. For the most part, with Greenspan, inflation was trending lower, and I think pretty stable, and I think he was happy to let that ride. The 2000s were an era where Greenspan handed off to Bernanke. The tech bubble had burst, and that recession officially ended in 2002 with the help of Greenspan cutting rates all the way down to 1%. But rates stayed at that level until around 2004 and only rose very, very slowly from there as Bernanke came on as Fed chair in 2006. So let's stop for a moment and consider what was happening at the time. As we all know now, Greenspan cut rates in response to the tech bust, and many would argue he kept rates too low for too long, and low rates created the enormous real estate boom, setting the stage for the 2008 bust. While some prominent economists argued that this was a great idea, it clearly wasn't. Low rates under Greenspan and Bernanke in the 2000s fueled such a high degree of financial market and real estate speculation that in response to a pretty run-of-the-mill recession in 2008, the global financial system almost collapsed, and that is not hyperbole. So was this preemptive behavior by Bernanke? I don't think so. However, the last 10 years have been dominated by Janet Yellen's tenure, and now we get to the point. Janet Yellen was vice chairman of the Fed in 2010 and became chair in 2014. See this graph? Now I understand when the journal is talking about over 30 years of Fed practice, they're talking specifically about Janet Yellen and her vice chair, Stanley Fischer, doing an utterly horrific job in their failure to meet one of their 2 most important criteria, inflation targeting. Why didn't the journal just say the story is about Yellen and more recently Powell? Janet Yellen was wedded to a model that led her to consistently, year after year, overestimate what future inflation would be. This model, called the Phillips Curve, has been discredited for decades and at a bare minimum should have been relied upon with a high degree of skepticism. And I'm going to tell you why it was so harmful that Yellen was blind to this reality. Even though rates were nominally low at zero, Yellen and her vice chair, Stanley Fischer, were constantly guiding that they would be shortly raising rates, and these expectations kept the dollar strong, and that kept a downward force on inflation. And the Fed, under Chair Yellen, consistently failed to hit her inflation target, missing on the downside. And what did she say every single time? She said they missed the target due to transitory factors, but that they expect inflation to move towards target in the future. Why? Why do they expect that? Before I answer that, let me ask you, do you know how to forecast inflation? No one does. Think about that. Before you think, who cares about inflation? Understand that if you could predict inflation anywhere from 3 months to 3 years out, and even if you did a bad job at it, but you were better than everyone else, you would be a multi-billionaire. This tends to sharpen the mind and tends to attract some of the best and brightest. Here's former Fed Chairman Ben Bernanke commenting in a Fortune article that the Phillips Curve is, quote, really the only model economists have for predicting inflation, end quote. So what is the Phillips Curve? In the 1950s, an economist named Phillips observed that an inverse relationship between the rate of employment and the rate of change of wages existed. Said more simply, if you're trying to hire someone and less people are looking for work, then you're going to have to pay more in wages to land that new hire. This is a pretty simple idea. Shortly after that, some other prominent economists came along and observed that this held not just for wage inflation, but for general inflation, and the so-called Phillips curve was born. The Phillips curve stated that there's a trade-off between inflation and employment, and that if there are many people out of work, then there is lots of slack in the labor force, and the risk of general inflation, not just wage inflation, is low. Conversely, if the percentage of people employed is high, then inflation must be right around the corner. The Phillips curve stated that there's a trade-off between inflation and employment, and if there are many people out of work, then there's lots of slack in the labor force, and the risk of general inflation, not just wage inflation, is low. Conversely, if the percentage of people employed is high, then inflation must be right around the corner. And I have to say, this theory sounds perfectly sensible on its face. You're probably thinking, sure, what's the big deal? But Richard Feynman said, it doesn't matter how beautiful your theory is, it doesn't matter how smart you are. If it doesn't agree with experiment, it's wrong. And we've been running this experiment now for many decades. The great Paul Volcker, Fed chairman in the 80s, dispensed with this nonsense because when he took over, we had high inflation and high unemployment. So where's the trade-off there? Here's what you'd learn by paying a lot of money to a very fancy university. We see in this stylized version that there's a very clear relationship between employment and inflation. You can move along this line and examine a trade-off. Lower employment means higher inflation. Lower unemployment means higher inflation, and vice versa. Here's real life. If you struggle to see a clear relationship, you are not alone. And this is when someone will say, yes, but if you lag this data and you smooth that data, and they'll propose all different ways to try and clean up this mess. And having looked at those efforts, I'll repeat a quote from James Mills. If you torture your data for long enough, it will tell you what you want to hear. I don't know exactly why it doesn't work, only that it doesn't. My best guess is because we were on the gold standard when these initial observations were made back in the 1950s. So in 2015, when Yellen and Fischer were failing to meet one of their primary objectives due to their dependence on this unreliable model, the Wall Street Journal highlights the obvious, that we don't have empirical evidence that this model works. And here's David Stockman, who says, everyone knows it's a bad model. The problem is no one has put a better one on the table that outperforms it. But here's the Fed, at the time, still talking about the labor market. The Fed says they want to be reasonably confident that inflation will move towards their 2% target and see further improvement in the labor market. So would they care to tell us What would give them confidence in inflation moving back towards target, aside from an employment-related Phillips Curve analysis? Enter Janet Yellen, who says she would need to see further strength in the labor market in order to have confidence inflation was headed back towards 2%. And then, as the journal correctly infers, the Fed could raise rates even if GDP and inflation were below target. Here's Janet Yellen towards the end of her term in 2017, admitting we don't understand inflation, and the 2017 inflation shortfall is a mystery. Even if you don't have a PhD in economics, think of a country that experienced high inflation, maybe Argentina, Brazil, or Venezuela, and if I asked you if the value of that currency was going up or down, you would probably know that the value of the currency was going down. It was being devalued. The value of the currency was going down. Here's the value of the dollar while Yellen continued to discuss raising interest rates. The value of the dollar was going up sharply, and that was sending an important message to Janet Yellen. Stop stepping on the brakes, step on the gas. But she wasn't listening. She called the dollar strength transitory and continued to focus on the Phillips curve, and then says it's a mystery why, as the value of the dollar is getting stronger and stronger, the Fed continues to miss its inflation target on the downside. And here's Yellen in 2019, after her retirement, after telling you that she depended on this model and says it's long been a workhorse, but then says the slope has changed significantly since the 60s, that it's become quite flat. And flat means there is no trade-off. Yellen would have us believe that something funny happened during her tenure. But the fact is, before she took over, the model had already not been working for decades. And since prior to joining the Fed, Yellen had a prominent career as one of the top labor economists that spanned decades. Surely she would have been extremely familiar with this model that, as I just showed you, to remind you, Bernanke called really the only model we have for predicting inflation. Stan Fisher and Janet Yellen consistently said they expect inflation to move towards trend, but why? Why did they expect that? They never gave a persuasive answer as to why that was true, and they never mentioned the dollar except when looking backwards. It was all based on a Phillips curve argument, which is not statistically compelling, that unemployment is low and therefore inflation must be right around the corner, but it never was. And that brings us to Powell, the current Fed chair. And here's a quote from Powell in 2018. Quote, "The persistent shortfall in inflation from our target has led some to question the traditional relationship between inflation and the unemployment rate. My view is that the data continue to show a relationship between the overall state of the labor market and the change in inflation over time. That connection has weakened over the past couple decades, but it still persists, and I believe it continues to be meaningful for monetary policy." Yikes. That said, Powell has had at least 2 scares since that quote, and I think this story in the Wall Street Journal last week is saying that the Fed will believe we're getting higher inflation when they see it. Why is this important? We have a major problem. Household debt levels are through the roof. Corporate debt levels are through the roof. Government debt levels are through the roof. And this is the historic position we find ourselves in, where we haven't been for a very, very long time in this country, and never during the post-war period. We've had artificial booms that were stoked by the Federal Reserve doing whatever is necessary to encourage more and more borrowing. The Fed attempts to centrally plan the economy with an eye towards avoiding recessions, and this is primarily done through interest rates. Lower interest rates promote credit growth that's unnatural, and this credit boom creates economic activity, but also huge distortions. The benefit is that we avoid recessions. There's a cost. This credit-driven boom that we've been living through for decades can only end in a deflationary bust or an inflationary boom, and the latter, inflation, is much more popular culturally and politically. I want to be clear about this. I think the existence of the Federal Reserve and what it does is the single most harmful element to our system. The Fed is responsible for creating massive distortions in our economy and hugely exacerbating wealth inequality. But as a practitioner, I don't get to design the world. We have to understand the world as it is in order to inform us to make the best decisions. So I've been talking about what the Federal Reserve and what Yellen and Stanley Fischer should have done to achieve their goals. I'm not making a judgment, in this recording at least, I'm not making a judgment on those goals. Yellen choked off inflation at every step, and because of that, interest rates stayed low, and because interest rates were low, debt levels that were already extremely high only continued to rise, which has only exacerbated the problem we faced when she came in. So only now do we start hearing about potentially letting inflation run above trend, which only makes sense if the 2% target is asymmetrical and not a ceiling. Because during Yellen and Stan Fischer's tenure, if you look at their behavior and not what they said, the 2% target was basically a ceiling, right? 2% here looks like a ceiling to me. Thanks for listening. Please don't forget to subscribe.